Hello, everybody, and welcome back. Interest in Japanese equity among international investors has increased significantly in recent years. How attractive is the Japanese stock market today? I talk about this and other questions with my guest, Max Godwin from Eastspring Investments, portfolio manager for Japan's smaller companies. Warm welcome, Max.
Hello, everybody.
Max, Japanese equities are back in focus of international investors. What are the main reasons for the renewed interest in this market?
Nothing succeeds like success, and the market has been going up, and therefore I think people are interested, and I think the background to that, for a number of reasons, is that profits, EPS, for example, continues to rise and is at record levels in Japan, and for a whole number of reasons, which hopefully I'll get a chance to mention today. But yeah, generally, nothing succeeds like success, and Japan finally, in terms of stock market and overall corporate earnings, seems to be in a very constructive phase, which seems to us to be a lot more structural than cyclical. I mean, there's a cyclical element to it, but a lot of it is structural as well.
Japan has emerged from a very long deflationary phase during the last decades. So how sustainable is the current development, and how are Japanese equities performing in the current environment?
When you think about deflation in Japan, I mean, it's a multi-decade story. I mean, Japan's been in a kind of deflationary equilibrium since around 1990. Which is almost 35 years. And it's, in a way, it's a personal story as well, because I've been doing Japan since I've been involved in the Japanese market since around 95 and managing money since the late 90s. And, after the bubble in Japan, I think the prices of everything, the price level of pretty well everything, including equities and wages and valuations in the stock market, was very, very high. And Japan as an economy had an oversupply of everything. Corporates were too leveraged. They had too much capacity. They had too many employees, too much labor force. And when I joined the market, people said to me, "Oh, soon this kind of correction process will be over." And the reality is it's taken another 25 years, but I do think that finally we are there. And the reason I think it's sustainable is that it's the opposite of where we were when we started. That the price level of everything, whether you're talking about valuations in the stock market, level of wages, the cost of dining out in a decent restaurant, etc. Japan is kind of cheap now, and also, whereas before we had excess amount of labor, excess capacity, now there's shortage of labor, there's shortage of capacity. I think the other thing, I mean, the amazing thing, for example, is that you compare wages to China. Some corporates that we're talking to recently, they say that it makes more sense for them to onshore manufacturing production back into Japan because it's cheaper than doing it in China. And that's just kind of amazing. And I think that's why, I'll go into a number of reasons, but I think really that's why we think that it's sustainable in terms of reflation. And in particular, you need wages. You need wages to kind of continue increasing, to have an inflationary spiral rather than a deflationary equilibrium. And I think wages, the signs are very positive that wage increase also will continue, because the demand and supply for labor is just very, very tight. And that's a new development. It was always the opposite for the last 35 years. So we're pretty bullish structurally on the kind of reflation story.
So today we live in a totally different world compared to 3 years before. So interest rates, inflation, the economic cycle, geopolitical factors. So what are currently the biggest risks for Japanese equities?
Just taking the ones that you mentioned, I think geopolitics, I mean, assuming China doesn't invade Taiwan or something, or some other similar, geopolitical event, the kind of US-China, if you like, economic competition is actually, I'd say, is quite positive for Japan in many ways, because Japan is firmly in the US camp, and I think, for example, there's been a lot of inward, semiconductor manufacturing investment planned and coming online domestically in Japan, and that's all part of this kind of, splitting of the world into two camps. So I think in geopolitically, Japan's in a good place. In terms of what could go wrong and what are the biggest risks for the market, I always feel the biggest risk for the Japanese market at the end of the day is the global economy, because although the Japanese stock market is big and broad, they have many domestic sectors as well as exporters. At the end of the day, Japan is certainly overweight in terms of the stock market of manufacturing companies, and that tends to mean that you need volume demand from the rest of the world, and if you don't have that, then Japan equities tend to be a fairly cyclical asset. So I think everyone says the outlook for global equities, or sorry, the global economy rather, is reasonably benign at the moment, and so that's a fairly favorable environment for the ongoing structural changes that you're seeing in Japan.
The falling yen has contributed to the attractiveness of Japanese equities as well. So how sustainable is this development, and what role does the currency currently play in your portfolio considerations?
The weak yen is more of a strong dollar than a weak yen kind of phenomenon. And you look, I mean, the dollar yen tracks very tightly in terms of correlation the interest rate differential between US Treasuries and JGBs. And while Japanese rates may have risen in terms of the yield curve a little bit recently, the big driver of that big increase in that difference has been US Treasuries because of inflation globally. So the real question is, where's the yen going to go from here? And everyone has been saying for the last year and a half, it's going to get stronger. But the basis for that was that inflation would disappear globally quite fast. And of course, even if it does, even if US rates come down at some point at the end of this year and next year, it seems, at least to me personally, unlikely that you're going to go back to the very low levels of inflation globally and in the US, and the very low levels of interest rates that you had, for example, during COVID. So it's kind of hard to see the yen, it's kind of hard to see that yen dollar interest rate differential really going back to the lows that it was before, which means that, the yen possibly could strengthen to 135, 140, something like that. But it's still a pretty benign environment for exporters. And to some degree, it would help the kind of import the domestic economy as well. So so I think in terms of outlook, we're not too concerned about the yen. Then in terms of portfolio construction, I mean, the way, we're long-term investors, so we try not to take a macro view on where interest rates are going to go, or where the macro is going to go, or where the yen's going to go. So we tend to just assume the kind of average for the last 10, 20 years on the yen when we're valuing businesses. So we tend to be pretty conservative as well. And actually, the kind of FX sensitivity of our portfolios at the moment is pretty neutral.
How do Japanese equities compare on an international level in terms of valuation, and what are the earnings prospects and drivers, and in which areas is there still room for expansion?
certainly on a PE basis, topics or MSCI Japan, it hasn't really re-rated because the EPS has been going up a lot. You can look at what the drivers have been for that EPS, and some of it has been cyclical. For example, good global demand and the weak yen. But there's also been a lot of kind of structural stuff. First of all, the kind of reflation, if you like, and higher interest rates are really driving bank earnings at the moment, which means that the financial sector and whatever has done extremely well. And then there's the whole kind of corporate governance and improvements here. So there is earnings prospects generally are pretty good. The question is, we're kind of, certainly as a starting point, we're value investors. So we always look for things which are really, really, really out of favor in the market in terms of, our starting point. So at the moment, what is still, for example, really out of favor is anything kind of China demand related. It could be EVs or machinery or whatever, because, we know China's kind of in a kind of cyclical weakness. And then I think other areas are where the weaker yen rather has tended to hurt short term, at least, the kind of business prospects of certain companies like retail, housing as well. People are worried about rising interest rates and therefore affordability, this kind of thing. So these are just some examples of a couple of areas where things are very, very cheap, and we've been adding names to the portfolio. But generally, what's attractive is that right across the board, across many, many different sectors, and in fact, across all sectors, there are some stocks now which coming up on our screens and looking quite cheap.
How could decisions by central banks in Europe and the US affect Japanese equities in the near term, and what interest rate cuts would mean for the old value versus growth question?
Touch on a couple of the things I've been talking about. So one is the yen. Obviously higher rates, especially in the US, are weakening the yen. And then, so what happens to US rates going forward and the level of inflation and that kind of thing in the US is important. And I think the other kind of obvious issue related to interest rates is kind of macro demand. And if rates start to come down in the US and we get a kind of soft landing globally and in Europe as well, then it's pretty likely that cyclical demand will be pretty strong for Japan's kind of export manufacturing companies. So, if rates come down a little, say in the US, it's likely to have a slightly stronger yen. But on the other hand, it may have a stimulative impact, on the kind of global cycle and demand, etc. So it's not necessarily a bad outlook for the market. In terms of kind of value versus growth, I mean, where the value is at the moment, it tends to be in cyclicals, in particular in domestic names as well, and domestic type cyclicals, kind of soft cyclicals, if you like, retail and housing and the things that I've been talking about. So, I mean, the interesting thing actually is that in contrast to the rest of the world, since around, during COVID, and the aftermath of COVID, then growth as a kind of factor did extremely well in Japan. But since around mid-22, value has actually been outperforming in Japan. And for us, the kind of what's expensive and what's cheap in the Japanese market, more than a kind of style factor, value versus growth, or more than a certain sector, it's just the kind of mega cap versus mid and small cap story. And I think mega caps have really, really shot the lights out and look to us very, very expensive on even fairly optimistic kind of earnings, longer term earnings outlooks, whereas small and mid cap have lagged significantly, and that's where we see the real kind of attraction in the market going forward.
So this was Max Godwin from Eastspring Investments. Thank you very much, Max, for being with us today and sharing your insights on the Japanese equity market.
My pleasure, Thomas.